Good afternoon, everybody. My name is Dylan Malberg. I'm one of the advisors here at Secured Retirement, and thanks for joining us here this Monday. Today, we're going to be looking at inflation in your retirement, and let's make sure that everyone's prepared for those rising costs that they're looking at. First thing to start, the obligatory disclaimer here. Nothing that I'm going to talk about today is meant to be specific investment, tax, legal advice. Everyone's situation is different and thus should be planned around that way. So inflation, if you've looked in the news headlines, we've heard that word a lot, which is, again, we've spent a lot of time on it personally here at Secured Retirements. So we're going to spend some more time on it as we turn into the new year here. Just a definition right out of the dictionary: inflation, a continuing rise in the general price level, usually attributed to an increase in the volume of money and credit relative to available goods and service. Shorter way to say that is too many dollars chasing too few goods. Basically an increase in demand with a decrease in supply, which we'll talk about here today. So the three examples today that we're going to talk about around higher inflation or where it could cost you. And another thing we have to look at is also everybody's different individual true inflation rate is going to be different per family, as every family is going to be buying different goods and services. So one family could experience a tougher time with the inflation than the other, again, based on where their specific situation is at and what they need as far as their lifestyle is concerned. First one, cars. I think everybody's heard of the chip shortage, and we're as the pandemic started in 2020, it was the new cars that were generally cheap. No one was driving, and now as we've moved into 2021 and 2022, it seems like we can't find any used cars. And really, why are we bringing this up? If we look at just the true inflation rate around car services has been basically zero the last 20 years. And now we've seen more than a 1% increase in a year-over-year basis from December of 2020 to 2021. And really what it is just and this is a quote from Jared Bernstein here from the White House Economic Advising. It's just a reminder of how unusual the inflation is. Again, it was all with all the stimulus, all the money that's been pumped in the economy. You're seeing all these dollars that are chasing fewer cars. As again, we can't find the chips, can't make the cars. If we can't make new cars, you don't have the used cars that follow them. Again, here's talking about some of the time that inflation was even negative, and here's that spike here that we saw here with the last year over year. Your home, I think if anybody's done, whether they built a house or they've done a home remodel, about a third of the rising costs are in the home. And I think everyone's seeing it, again, whether they're doing a bathroom or building a house, ground up, whatever it might be. We look at really why that is. One, there's labor shortage, which isn't necessarily specific to this industry. We see that in a lot of different areas in the economy. That, and we've seen some experienced workers exiting to find other opportunities or start their own business, whatever it might be. We've all heard about the supply. We've heard about the ships off the coast, the costs just associated with shipping, not be able to get the trucks and the drivers, be able to do it. The supply chain issues, and really what that is doing is, one, the prices are going up, and also the timelines that getting projects done are stretched out longer than maybe they were before. And despite everything that is going on as far as the inflation, supply shortage, labor shortage, families are still investing in their homes, remodeling, moving. You look at where home prices are at, it's attributed to this as well. Number three, looking at just your cash. You look in the bank, your cash is getting you 0.01, I guess we'll give it here today. And we're seeing inflation coming at 7% year over year right now. If you look in the savings account, congratulations, lost about 7% last year as far as your cash is concerned. Not saying that there's not a spot to have the cash. Everyone, you heard the 3 to 6 months emergency savings. That's still very important. We want to make sure that you do have the cash set aside should something unforeseen happen. But now more important, just not having seen these inflation numbers for, since probably over 40 years ago, really looking at if you're sitting on an excess of cash, it could be an opportunity to maybe find a better spot for that, those savings to be where they're not going to be able to beat inflation, but at least they're not getting zero and they're keeping pace a little bit better than actually just sitting in the checking savings account. So looking at really, we know inflation is the issue. We've gone through a few different examples of really where it is. I think a lot of families have seen that and experienced it themselves. So what can we do to really prepare for inflation as we look at our retirement plan? Really, we look at investing, and the number one way typically that money managers, or we've been told to lower our risk as far as in the investment accounts, is let's incorporate fixed income or bonds. A couple of things, really looking at more the long-term fixed income. Long-term fixed income rates right now are not great. And locking in rates, if you're going to own something that's 15, 20, 30 years in the future, and you're still locking in at a rate, if it's at 1%, I'm not sure what the 10-year ended up on Friday. But if you look at what the inflation is going to be over the next 15, 30 years, is that 1, maybe 2% really going to be able to withstand long-term inflation. So also, as we look at ways to, and we're actually going to have our lunch on there next Monday here at noon in our office here in St. Louis Park, and we're going to have our investment strategist, Nate Zeller. He's going to spend probably, I'm assuming he's going to spend a little bit of time talking about inflation as well, and what the Fed is looking at doing to start to curb it. And one of the things that they've announced here over the last few weeks is multiple interest rate hikes over the year 2022. We'll see how many they do. But we all know that fixed income bonds have an inverse relationship with interest rates. So as we start to see interest rates rise, the underlying market value of these bonds are also going to decrease. So looking at, is there any other alternatives to get the protection that bonds have historically provided without the interest rate risk that they do provide right now? Looking for assets that are going to be able to keep pace with inflation. What we're talking about here, typically you're looking at stocks, maybe some commodities that are in there. Whether it's the S&P 500, a more concentrated portfolio with maybe a money manager. These are things that are going to be able to historically keep up with inflation, right? Especially with our interest rates where they're at right now. There's such a difference between the year-over-year inflation and what you can go get in the bank or even a 10-year treasury right now. So having to go out to the equity markets, and you have commodities as well that typically are going to increase in prices when you see a lower supply and this increased demand. More hard assets that are out there, maybe it's precious metals, any other commodities as well. And also looking at just your income plan and retirement, there's some assets that are out there that have guaranteed payouts that may be able to keep pace with inflation better than others. There's some things out there, real estate, maybe it's more dividend income, buying more equities that are paying out dividends. Maybe there's insurance products that might make sense for you in your situation that'll be able to pay you that guaranteed income, as well as provide some inflation protection. Also in here, looking at your Social Security strategies and how you take your pensions. Let's make sure we're looking at those in their specific situations, but also looking at the overall plan and how those sources of income are going to fit into really what your goals are long-term in retirement. And then the last one here, just spend wisely. And this isn't meant to be a, ramen noodles and clip coupons, spend wisely. This is just as we go into 2022 and we have the inflation, doesn't seem like it's slowing down here at all. Just keep an eye on really where your spending's at. Just make sure that everything is staying and adjusting for inflation the way that it should be. And I know we've had quite a few meetings with current clients that we've had here at Secured Retirement. We've when we put the income plan together, we've talked a lot about it. What happens about inflation in the future, and lucky we did, because now we're having those conversations and we're able to adjust these plans accordingly to make sure that our clients are being able to continue to spend securely in their retirement and not have to worry about necessarily direction or what's going on in the markets at the same time. Any questions? There's gonna be an offer here in a little bit here to schedule some time. But if you're looking at retiring in the near future, the best place or best time to start planning around something is usually today. If you know what's coming up, let's start putting a plan around it. We only work with retirees here at Secured Retirement. It's what we do every day. And families tend to hire us for 3 reasons here. One, they want to make sure they have the income that they're going to be able to spend in retirement. They're going to not wish they had money back in their 80s that they spent in their 60s. The second reason is, which we haven't talked about a lot today, but is around taxes. They hate taxes. They don't want to pay any more than their fair share than they otherwise would have to. And that's another area that, as we've had all the stimulus, everything's gone through, inflation might be something that, and we feel that this way at Secured Retirements, is we're going to see a big inflation around taxes. So everything else that I've talked about today, also making sure that we're looking at how can we lower your overall tax liability long-term. That's really where we add a lot of value for the families that we work with. And the third reason is we're going to try and grow your wealth. Again, we have the lunch and learn next Monday at noon with our investment strategist, Nate Zeller, talking about our outlook on 2022 in the markets and looking back at 2021. We like to grow your wealth, but we're not going to do that at the sacrifice of your income or saving on taxes. So you should be able to click on this link here. And it's a handout, inflation and retirement, a little bit of reading, expanding on what we've talked about here today. If you have any issues with this, reach out to our office. We can make sure we get that out to you. Again, next Monday, 24th in our office here in St. Louis Park. It'll also be able to be streamed by Nate Zeller, investment strategist, CFA, talking about our outlook here at Secured Retirements on the markets, where we see some opportunities, what are some things we have to look around the corner on. And then also the next Monday after that, we're actually going to have Andy Ives with Ed Slott's group talking about qualified charitable distributions. It should be a good one there as well. If you have any questions, I'm going to throw up a offer here. If there is any questions, feel free to schedule some time. Speak with one of the advisors on the team here. If you're a current client of ours and you want to review your plan of what it looks like as far as the inflation is concerned, maybe it's the markets, just a general review. Again, take advantage of the offer, reach out to our office, and we can find time to review that with you. So I think we see, so it looks like Tim's got a quick question here. Current administration talking about targeting 401ks. I think it's a good question. I'd say that targeting 401ks can be kind of a general look at it. I think that you look at really where I think the tax code's going to be going here as far as the rising tax rates that they've been targeting 401ks as far as how they're going to tax them in the future. And there's been some proposed tax changes as well as around eliminating things like Roth conversions, even contributions, limiting the amount that you're able to hold inside these retirement accounts. So I'd say that because of everything that is being proposed, that now is as good a time as any to be as proactive as possible around not only your income plan, but also what can we do around your individual tax plan to making sure that you're in a situation where we can eliminate as much of this legislative risk. Just knowing that every time that Congress goes and meets, we never know, they could make a change to the tax code. So let's start putting together a plan around how can we lower our overall tax liability there. So if there's not any other questions, again, want to mention one more time, we are going to be having our lunch and learn. If you are interested in that, reach out to our office. We should have some other invites going out as well for it this week. But we'll have a presentation next Monday at noon. Our investment strategist, Nate Zeller, talking about our market outlook, a recap of 2021. We'll have lunch, and as well, if it's easier for you to stream it from home, that works too. But we look forward to seeing and talking to everybody next Monday. Hope everyone has a great rest of your week and the weekend coming up.